Good afternoon, everybody. Welcome back. So we're joined now by Ben Ryan of Commodity Research Group. We've spoken with a number of different partners at Commodity Research Group: Andy LeBeau, Ed Meir, Jim Colburn, and we haven't had a chance to speak with Ben. Ben takes a look at the metal market and helps Ed Meir out with some different ways of expressing his views. So Ed, kind of comes up with the macro views, and Ben kind of helps him with different optionality ways to help initiate those sort of positions. So it'll be interesting to speak to Ben. Ben, welcome. How are you?
I'm doing great. Thanks very much for having me on, Mike.
Yeah, no, it's great to see. So we're looking at a page right here. Tell us what we're looking at here.
Sure. So thank you to my friends at Vela, Chris Herndon specifically, who allowed me to use their software to do this demonstration here today. What you're looking at here on the right is a futures ladder for DC18 gold, which is the current futures contract. And on the left, what you have is a pricing screen where you can see the price of different options. And we can go through, particularly if the callers or the listeners have any thoughts about gold, I'd really love to talk about, as you put it, Mike, how we can express ideas we have in the marketplace and where options can be useful. I was just catching the end of your last segment with Kai, and like you see in 5 or 6 charts, so many different trade ideas that might, inspire you to go and take a look and do a little further analysis in a particular name, area, or particular play. And with all those ideas, you go back, you do a little technical analysis. People on the site or people who are, subscribers to you, I imagine, are all going to have their different reasons to take certain views on a market, all of which may be very valid at any given time. The thing you want to have in your arsenal is this understanding that options aren't always the best way to play a name. Sometimes you just want to get long and buy the outright or buy the future. But sometimes you have a very specific concept about how you want to initiate a trade, maybe some ideas about the timing, strong feelings about particular points of support or resistance on the chart. And there may be ways that you can use options at a given time to get yourself a better risk profile on your trade than just buying or selling the futures. Is that always true? No, I would actually say it's true. Certainly not the majority of the time. Options are not always the thing you want to do to express a view, because there are a lot of things that can happen in an options trade that are, unexpected to people who don't have a lot of experience with them, and trades that you think would go in your favor don't. But if you have a very specific concept, options might be able to give you some real levered upside with similar downside risks. And as we go today, we could talk a little bit about that. So if anyone has any thoughts or questions just about that in general, even if it's not gold related, please feel free to reach out on that. And then, Mike, ask any questions you might have. But here I have a chart that I can bring up, and we'll go back to the options screen in a little bit. Just wanted to familiarize everyone with what we might be looking at. And here, in the context of this conversation, we can talk about certain price points as you're looking at a weekly gold over 3, 4, 5 years. We could talk about different points that we might have views on the chart where gold might break out or break down. And if someone has a view, we can take a look at the options over different time frames and whether we might be able to match those views up with a actual trading concept that might yield us, some positive return.
Absolutely.
So I'll just, if you don't have any questions yet, Mike, I'll just talk a little bit about what I'm seeing on the chart here.
Yeah, well, definitely take us through the chart and tell me, we're stuck, right here. It's pretty interesting. Vince Lancy, who actually does a lot of work with us, writes a piece, often he writes, but, it has a longer weekend piece. And last week he talked about buying gold. And, we've had a strong week in gold despite yields higher and the dollar a bit stronger. And so here we are, we're up a few dollars. I don't have the exact amount. We're probably up $12 or $15 on the week, something in that range. But what do you think? Here we are, we're back above 1200, we're at 1206. What are your thoughts here?
Sure. So you have a good view of the chart, right?
Yep.
Okay. So I like to bring this up, and you can ignore some of my lines, but I like to bring this up, and I like to look at it sort of long term and then condense it down over time into shorter time frames, just to try to see if we can understand a narrative, right? And like you said, it is interesting that you're seeing some support at this spot. You might expect gold to break down out of consolidation here at 1200 given the recent news where the interest rates are starting to pop, which is generally bad for gold, at least in the short term, and the stronger dollar, you might expect to see gold break down. So the fact that it hasn't in the short term, I listen to watch the chart more than I try to let my own, opinion about where we are in the cycle enter, my thought process. If it looks like there's strength here, I think Vince makes a good point, because you have some good upside targets because you're kind of at the bottom of this range here. And I like to look at this 10-year just to give context of visually a little bit, get a sense of what's been going on and see why this 1200 level, it's like, the biggest yawn ever. It's been sitting or coming back to this level now for literally over 7 years. And you go back to, let's say, about 2010 here, 1200 becomes support, resistance. It stops again here in mid 2010. That was 09 here, kind of topped in there. And then it has this breakout to its major highs when everybody is expecting runaway inflation due to QE. And then that party starts to end and we don't get that runaway inflation. And then gold basically, I'd say here in early 2013, comes right down to 1375. And if you notice, what's so crazy in looking at this gold chart is that the time spent between 1300 or 1375 and 1530 is almost zero on the chart in this context, even though it ran up to 1923. It's a very quick move up here while the buying really ensues in a major way in mid 2011. And then when it breaks down below this 15 quarter level in early 2013, it really just gaps right through this area. And since going back to about 2013, we've had this 1375 area be our major point of resistance. Now, we could talk about different support levels, but if you take a look and just look at where my cursor is on the screen, you can see where 1200 just time and again has been this major support or flip level. And also, if you go back further into about 2015, in here, you'll see just mass consolidation around this level. So it's on the long-term chart, 1200 is a place where buyers and sellers tend to be comfortable matching up with each other, and no person, unless there's a major reason in the market, feels the need to push it out of this area until there's a catalyst. And I think right now we're sitting there in this kind of boring spot at 1200, but it's a good time to pay attention because, as you pointed out, maybe you pointed out the higher interest rates and gold's resilience. Perhaps that's a sign that there are some buyers who are saying, you know what, in the big macro picture here, I like the price action on gold, and this is a good buying opportunity. So it's an interesting time, even though it's a boring time, if you know what I mean.
Yeah, well, it's funny looking at this chart. The one thing that really strikes me, because there's a beautiful chart here, the way it's kind of laid out, but just the lack of activity over the last, it's almost a 5-year period here of gold hovering in about $150 range.
Yeah, that's exactly right. And if you look, going back to 2013, you see this line here, and you see this line here. This was a very clearly defined downtrend. And actually, if you notice, it actually created some of the better opportunities for trading, because what you notice is when it interacted with these extremes on the line, it tended to move off very quickly. So you might have a situation similar perhaps to where we are now, where you have kind of this dip down to a level. If this proves to be support again, as it has, one might expect some level of acceleration once it can break away from 1200. So you saw this sort of pattern, but what you ended up seeing was the downtrend was broken, interestingly, where? Right around 1200. That was the day that gold took off. It was February 11th, I believe, 2016, or somewhere in there. I guess I can look right here, February 9th, 10th, February 8th. So gold broke out of this major downtrend that had lasted for a number of years at 1200. So that's when I say it's a flip zone. It's also a point of the biggest break we've had in what you just classically classified as a pretty boring situation the last 5 years of essentially of consolidation on the long-term chart. But within that, the breaks of the downtrends and uptrends that have sustained on a multi-year basis took place at 1200. That's where the biggest break took place. So what I see is in early 16, you've broken out of this downtrend that started in early 13, about 3 years. We've broken out, and then boom, it runs back into this 1375 area, which we've mentioned as being major support and then major resistance now ever since it's broken into this downtrend. So that's what I saw. It was a failing of the downtrend here in 2016, but then it fails to break out above that. So here we come back to this very significant level, if only because it's where there's been so much consolidation historically, and also because it's just a point where the last major breakout, it was kind of the place where the buyers all got, the sellers all got taken out. And you saw it because gold rallied up to 1265 that day, a major move. You don't see $60 moves in gold very often. It was because it's the major spot. And once the buyers and sellers clear each other out at a major point on the chart, there's potential for acceleration in whichever direction the commodity moves. And again, that's why I think it's an interesting spot. And I'd like to hear more about what Vince has to say on why he thinks it might be a nice case for a bull move.
Well, I'll give you a plug on that. You can join Vince every morning on the Gold Fix. He's been coming on at 7:30 every morning talking about gold, and so you can get his thoughts there. So that's every morning. But so, what are you thinking about here? If you're bullish, and let's say for different reasons you're bullish, how would we structure that? Give me a few different ways to structure a bullish play with good risk return opportunities.
Cool. So let's do that. So I think we've seen, let me just show, so we're all kind of on the same page on the shorter term on the chart, and then we'll take a look at the options. So I like to drill down here. So again, this is the kind of a 3-year look at gold. So you see it breaking out of this downtrend here, again, right around 1200. And this is on this shorter term chart, you can probably see more of what I'm talking about is this consolidation and this point at 1200 where on its way up, gold would come down and it held at 1200 again. So it's got that historical significance. And then as we move forward in time, as we take a look at 180 day, it's pretty tremendous to look back at, this is, am I on a 180? Sorry, I think I'm on the wrong one. So if you look here, we had this big move back up to 1370, and it looked like gold might break out finally, and it didn't, and it failed, and we moved down pretty quickly. Gold got caught up at 1167, and that got bought. And if you see since, there's really been no ability since mid-August for gold, despite not going up very much, they haven't been able to bring it down and retest those levels. So if you believe that, okay, it looks like the downtrend is over in the more short and immediate term, as you say, we're maybe in a consolidation pattern, and it looks like we're making at least not lower lows, how do I play this bullish? So the answer comes down to, of course, time frame. When you're thinking about options, you want to think about time frame. But one thing in the simplest case that we could look at is just this idea of going short a put, and going long a call, and doing it in a way that you don't really spend or collect money on the trade. You're doing it flat premium, meaning that the call you'd buy would be equivalent in premium to the put that you would sell. But in order to do that, you have to be comfortable with this idea of, if it goes below my short strike, that means I'm going to get long, and I can't stop out the same way I could as if I was owning a future, because if I owned a future, then I could just sell it whenever I want. When I'm short the put, the other person has the right, whoever is long that put has the right to exercise or not, and I'm sort of beholden to what they choose to do. So I can sell the put outright in the money. That is something you could do. But the point is, you can only do a strategy where you're short a put if you're comfortable with gold going down and holding it, right? Because you could look at this chart on a long term, just to bring it back, and you could say to yourself, well, actually, if I look at it, it looks like gold's kind of rolling over here, and maybe it breaks down again, and then it could break all the way down to 960. If that's something you're concerned about, maybe you don't want to be short a put in the intermediate term, because it's true that if this significant level we're at breaks, there might be acceleration to the downside as well. But if you are comfortable with it, what you might consider doing is saying, okay, let's look out 2 months. So this is, if you look at the top, December 18, this is the second month out contract. And I can look here, and I can see it expires in 54 days. Okay, so it expires in basically at the end of November, the beginning of December. So I might say, you know what, before, just how I might approach it, before the end of the year, before the end of November, I don't think gold's going below 1160 again. We'll go back to my chart. What was my low? On a shorter term, we'll say the low is 1167. So I don't think it's going to take out that low. So what's an interesting strike to choose? You could take the 1165 put because you don't believe it's going to go below there. So you'll sell that strike, collect the premium from selling that strike because if it goes below 1165, you're going to be a buyer anyway. So you're essentially, by selling this put, saying, I'm going to collect premium in the near term instead of just owning a future where I can't buy at 1165 now because it's trading 1205. So why don't I collect some money in the near term? And if it gets down to 1165, I'm happy to buy it because I think that 1165 level is going to hold. So if you look at the market, on the left, we have our bids here. On the right, we have our offers. This is $4.40 at $4.60 for the put. So if we wanted to hit the bid, we could collect $4.40 by selling the 1165 put in December. So what I might want to do is look at a way that I could do this trade flat premium. So if I sold the put at $4.40 here, I have $4.40 of spending money, if you want to think about it that way. And if you look at the 1255 call, you see that it's offered at 440. So I could hit the bid here at 440 on the 1165 put, and I could buy the call here at 440 on the 1255 call in the same expiration. If it settles anywhere in between, nothing happens. I've just lost the commission I paid on the trade, but no gain or loss. But if it goes below 1165, I'm going to be forced to buy futures at 1165, even if it continues to drop. And if it goes above 1255 here, I'm going to have upside from there. So how does that work? Very simply, for people who aren't familiar with options, if you buy the 1255 call, let's say we go to November 1st in the future, and gold is trading, here we'll look at a 20-day. So all of a sudden, gold takes off from here, let's just say in the next 2 months, and it comes back up to here. That's a pretty logical place to go, 1280, right? You see that there was some support here, and then gold kind of broke down at 1280, and it's never come back. So if you want to make a retracement play, kind of like Kai was talking about on the previous podcast, here at 1280 might be an interesting spot. So if that just happens to happen within the next 54 days, going back to our options, I'm buying the 1255 call. And again, because I'm financing selling this put, I'm net flat and not spending any premium on this trade. So owning the 1255 call, I get to buy one future for every call that I own at expiration at the price of 1255. So if it's trading 1280 in 54 days, I'll have made $25 on a trade that I didn't make any premium outlay for. Now, it may not go to 1280. We may sit at 1200 and be stuck forever. But if you're comfortable getting long at a price like a logical price, like where there was previous support, like 1165, and you want to give yourself some upside, it's interesting to consider plays like this, especially like the one we just talked about, where the technical levels on the short term actually don't seem that impossible, given the fact that these levels have been significant before. So that's the kind of stuff I like to look for when I'm trading.
So are there any trades right now that you like, for instance, that optionality that you're looking at that really pique your interest?
Well, so I actually genuinely would do that trade, the one I just discussed. I would sell the 1165 put in December. In the December contract, because I do think there's a good chance that, at least for the time being, we don't collapse back to that level. I like the fact that it's been almost 2 months and there hasn't even been a real shot made at it. As you pointed out, there's been some news out there that would sound potentially bearish for gold. But if it's at this point where the chart is showing strength, I don't mind putting a 54-day trade on and being short down here to get long at this price. I would get long at 1165. And hey, the upside of getting $25 from this 1255 strike here that I would be getting long at, seems like there's not a whole lot of resistance in this area between 1255 and 1280 if you look at it on kind of like a 4 or 5 month basis. So
What
I
about
like.
somebody structuring something for somebody who is very bullish? That said, they do think that it can get, if we start to take out last month's low, we start taking out 1180, that, basically something, they're bullish, but they're cognizant of the downside. If we start taking out 1180, they're losing conviction in options. What sort
Gotcha.
of structure can we look at there?
Yeah, sure, absolutely. So there are a couple ways you could look at it. You could look at it just in terms of pure movement. You could say to yourself, I want to buy the straddle, which would be buying the put and the call, and the 1205, if that's where we're trading now, the 1205 put and the 1205 call. Let's just, for everybody's context, if they're just thinking about the way this is priced, you see that it's 18 bid at 1830 on the call and 1640, 1660. So that's 16 and a half plus, call it 1820. You're looking at like $34.60 in the straddle that'll expire. Let's just call it $35 that expires in that 54 days. So if you were someone who believed that you were bullish, but you thought there was going to be movement in either direction, then you would ask yourself the question of, okay, I have the straddle here that I'm buying at 1206. Now, straddle means you're long the call and the put. So if you go down, you want movement, big down, big up. You don't care. You just want it to move away from the strike so that you can profit the distance between the strike that you put it on and wherever the trade closes. So it's an absolute value trade. Either direction, you don't care. You're happy. But in your case that you just gave, Mike, you said you're bullish, but you're concerned that if it goes down to 1180, it might continue to move. Okay, so you're even though you're bullish now, you're happy to be wrong and make money on the trade, right? So if you believe, the question then becomes, is a $35 straddle with 54 days to go, do I have any conviction either way about whether or not that is likely to be a move, if it's likely to stay inside of there? What's the likelihood we settle right here at 1205? So think about it this way. If you settle 1205, if you buy this straddle, this 1205 straddle, thinking it's going to move in either direction, and you settle right at 1205, you've lost the $35 that you spent on that straddle. The question is, if you wanted to get long here, what would your downside stop out be if you were long the futures? So take the same $35 we just said we'll spend on the straddle for 54 days. Granted, with futures, the expiry is later. You can always roll it. But you basically have $35 of downside, which should take you down to 1170, right? If you got long right here at 1205, it drops $35, you stop out. That gives you $35 of downside to play with just owning the future. So I would say to you that I think if you have reason to believe that there are catalysts in the market, and this is why you want to kind of look at it on a multi-factor level. So if somebody's looking at momentum, or they have a reason to believe that there are catalysts in the news or in the charts or perhaps in the commitment of traders or something like that, where you start to see money moving and believe that that's going to reflect in a movement of price. If you believe that, then owning that straddle at $35 really isn't so bad for a 54-day look, that gives you this opportunity that if you think gold's really going to take off, let's say, and go back up to whatever uptrend line I have here that just interestingly ends at 1375, well, then you spent $35 and you get 140, you make 140 because you spend the 35 on the straddle. It goes up from 1205 to 1375. So that's 170. So you've ended up making about $140 on a trade. Now you would have made more just getting long, but again, you would have been forced to deal with this idea of, oh no, what happens down here? I'm losing conviction, and maybe get yourself out of the trade. So we could look at that. We could also look at, that's a straddle play. We could also look at like upside in different levels. So let's take your idea where another view. So you might say, well, that's a nice scenario, Ben. You buy a straddle, but that's $35 a premium that I don't want to spend. And gold is trading, 1200. It's not moving. So why would I want to buy a straddle in a market that seems to be consolidating? I'm not trying to pick the end of this consolidation. That's a tough game to play. And I would agree. And that's the challenging thing that people have to keep in mind about options is you can have a really good trade setup or concept in your mind and be bullish and be right, but just be a little bit early to the party, which good traders often are. And then your options trade doesn't work out because the timing doesn't work out, even though the concept does. So if you're in one of those situations, you say, okay, I don't want to buy a straddle, but I'm also not comfortable, as you said, Mike, getting short, around 1180, because if it goes below there, the whole picture, falls apart. So one thing you could do, you can always just buy options and spend the premium. And that's the simplest thing. So if you're bullish and you say, look, I don't know if gold's going to move, I don't want to spend that much, I have $100 in premium to spend, you could just say, okay, I can buy, 20 of the 1250 calls and I'll spend that money, and that'll be like, my play where I accept that I'm going to lose 100% a lot of the time, but that 5 to 10% that I hit, I think I'm going to make X amount, and I think over the long term that's going to be a profitable play. So you can always do that. Just be aware that you really have to be careful if you're going to do that in the long only play. You just have to be careful to make sure that you're sizing your trades intelligently based on the relative risk you want to take. And what I mean by that is that if options that you're buying out of the money are expiring out of the money often, that means you're losing all your premium. And if you're losing 100% on your trades, you have to consider, a long or short trade, you're in gold just owning the futures, you might make 1 or 2 or 3% or lose 1 or 2 or 3% on average, but you're not losing 100% of your investment. So keep that in mind and make sure if you're going to be a long only player that you're scaling your trades down drastically if you're doing these options trades, because a few wrong trades that might, give you a levered look at something, if it's a 1 in 10 shot and it takes 5 to work, you're way ahead of the game. So, you have to be patient and size accordingly if you're going to be doing any of these, any long strategies, if you want to just be naked long. But another thing to consider is that the price of these options as you're in consolidation patterns tends to go down, right? So I can look here at, what do I got here?
Well, similar to what you were just describing, that's the one issue with, your first option example where you were selling the puts well below and buying the puts, I believe it was the 1255 put, something of that nature. That's a bullish structure, but the problem is you don't really make money unless we get above like 1260. Whereas we've been in such a low vol environment, you could be bullish and, you'd be happy if we get up to 1230, 1240. But in that first example, you make nothing, and you've been kind of right,
Yeah, absolutely, and I think you're pointing out accurately, and I think options are a great thing to know because sometimes the stars align and the risk just makes total sense with your trade. But I think your point is well taken that in a low volatility environment, which is what we're in, what that literally means, low volatility, is that the prices of options are going down, which means that you're getting, in theory, if the move ever happens, a better price to own the options when it happens. The challenge is, consolidation often just leads to more consolidation. So being short a put, out of a consolidation pattern, the idea is that it's either going to break up or break down, break out or break down. But usually once you come out of a consolidation period, it moves hard in one direction. So you don't want to be too short. Being short a put, like that first example that you referred to, might actually be, a little dangerous in your eyes, and reasonably so, given the fact that it takes less and less of a move for the premium that you're collecting when you're selling that. I just wanted to show an example here. This was for what we were just talking about, this idea of consolidation and then a breakout of the consolidation, usually leading to a more drastic move down. And I think if you look at silver, I found silver to be so interesting because if you just take a look at this chart, this is going back to 2016. So it looks like this high here, 21.22, is right around the time of Brexit when the metals all got a pop. So if you look and then back down at the beginning of the year, it was only down at 13, so it made like a 50% move higher. But look what's happened since with silver. Major consolidation. And look at this. If you look at the candlesticks here, look at how consolidated they come here in early 2018, right? It's been an incredibly consolidative period. And what happened when it came down here, think about this 1650 level is similar to the 1200 level in gold from a price perspective. It's this major point of consolidation. And then if you were short that put in this example, look at the move that you got down here, $2.50 basically in 2 to 3 months, having had 3 months plus right here of almost no movement. So that's a good point that you make, Mike, is that out of a consolidation pattern or a low vol environment, even if you have a structure like I just suggested where you're short the put and long the call flat premium, if you're not comfortable with owning and not stopping out on the metal at that point, you probably don't want to be selling those puts. So there's the long strategies that we just discussed. And then there's another thing we can talk about as well. So, which adds to the potential ways that you might structure this trade. And that is, let's consider the idea that you don't want to sell the put, but you also don't want to spend a lot in premium because you think it's possible that gold is just going to sit here. Well, let's take the example of having some upside resistance levels, right? Because you can be bullish, but also think that there's a certain point at which your bullishness will stop. And again, this is a perfect example here. We have this 1375 level that we've seen with this trend line here coming in, and we've talked about on the long-term chart. There's this 1375 level, as you can see here, looking at this line across the top, or approximately, is it had multiple tops. So if we believe, okay, I think gold's going to rally, I think we got a sort of a rounding bottom here, and gold's showing some nice poise here at 1200. I think they're going to buy it, but I think they're going to, if they bring it up here, let's say over a 2-month period, I don't think in 2 months gold's going to have enough buying power behind it to make it through this massive level of resistance, having just rallied $170. So what that means is you might say, look, I could find a spot. I could see gold making this major move up in the next 54 days. It's unlikely, but I think there's a chance that gold, something's going on. There's some catalysts in the world, and I think there might be some, short-term safe haven demand or something like that. I think gold can rally $170, but I still don't want to pay premium to have that option. What can you do? So you can look at this idea of doing a 1x2, which would be flat premium again. But here, instead of with our first example, instead of selling a put, we'd be buying 1 call and selling 2 calls at a higher strike, and doing it in a way that would balance out our premium, so that the two strikes we were short equaled the same amount of premium we'd spend on the 1 lower struck call. So let's just actually get to what that means here and look at the bids and offers here. So let's say we thought you just wanted to start to look for 1x2s that are flat premium. You can see here 730 bid at 750, and by the way, gold is ticks in tenths, so it's 730 bid at 750. This is 2 ticks wide bid and offer. So from an options player standpoint, this is wonderful because there's really no slippage, because the markets are so tight now that the electronic markets have taken hold and everything is so tight on the screens, especially in the first few months. You don't have to worry about getting picked off on your trade, because the worst that you do is lift the offer and hit the bid. And since the bid ask is tight, it's usually not the end of the world if you're putting on a longer term trade. So let's look at where things are offered versus where things are bid, and see if we can find a 1x2 that might make sense for the chart. Just for example's sake, we could take a look at what we were looking at, the 1300, 1375 1x2. So this is 30 bid at no offer. Let's just say that we could sell this for 40 cents. It's 30 bid at no offer. We'll say we could sell it for 40 cents or maybe for 30 cents. Let's just go with 40. Where can I buy something for 80 cents of premium? Okay, the lowest strike I can right here is 1330. So let's say I could buy the 1330s at 80 cents, and I could sell 2 of the 1375s at 40 cents, just for our example's sake. So that would mean buy 80 cents, sell 2 times 40 cents. We've done nothing. It's flat premium, 80 minus 40 times 2. So if we go back to our chart and we think about that in the next, and again, I say in the next 54 days for those who are just jumping on, because when we're looking at our options, I'm aware of the fact that the expiration on this particular month here is 54 days until it expires. And that's the option we're looking at. We're looking in December at this 1375. I think we said the 1335, 1330, 1375 1x2. So this, we can just click up the trade here, I think. So you can see I buy 1, I sell 2, and then it says, I don't know why that's theoretical value, but I guess it's because it's doing it off its theoretical value. But in the market, we can transact this at about 0, even though the theoretical values are off, okay? So what does that mean on the chart? It means that if we get to 1330, do you think it's possible that in the next 2 months we might be able to make this gap, close this gap here and get up to 1375? You could be very bullish, as you said you might be, but still not think that gold's going to crack this 1375 level in the next 2 months. You say you're very bullish, and I think anyone would agree you're very bullish if you think that gold is going up $170 in the next 54 days. It hasn't had a move like that in a while. So a 1x2 like that would get you the exposure where you can be long and make money. If gold were to go to 1375 in our example, you would be long the 1330 strike, which gets you long one future here. And if you settle at 1375 on expiration, that means you're not forced to be assigned on any of your calls. No one's going to take them. They're going to expire worthless, but you're going to own futures from 1330. So at 1375, you will have made $45 on the trade, which, by the way, is more than the straddle is worth now. If you remember, we talked about that being worth 35. So you could have made $45 on this trade if you were comfortable with taking the short leg. Now, what that means is if it had blown through and gone up to 1500, you would have been short one net future from 1375 because you're long one, but you're short two calls. And then ultimately, as you go to infinity, if you're short a call to infinity, that means you're short a future to infinity. So if we go to 1500, for example, you're going to lose money because you're going to be short from 1375 all the way up to 1500. You're going to be short 125, lose $125. You will have made the $45 from 1330 to 1375 when you were long one, but ultimately you're going to have this massive loser. So that's the risk that you take there. So there's no way that you're going to get a flat premium options trade. No one's going to sell you free options for nothing. They all cost something. But I think the key is when you think about the different examples we've gone through, Mike, is what is my risk profile and how do I see the trade shaping up? And what do I think is kind of the way this might play out? And what risk reward do I like for my individual trade concept? And you really have to look at it that way. I think sometimes you hear people, and I think it's terrible that they allow these people to speak about options. They'll say, oh, I just sell options and collect premium and it's been great because that's worked in this environment. But it's, an incredibly dangerous strategy. And you never want to be considering just putting trades on without really doing your homework and thinking about the risk associated with it. So I think you have to think about the different structures you can put on and ask yourself, am I comfortable getting short, basically with a break even of 1400 something on this 1x2? Or am I comfortable getting long a future at 1180 if gold breaks down from 1200 in the next 2 weeks? Or might I be in a spot where gold's going to continue to plummet and go back to 1,000 or something like that? So you have to take each example and put it against the risk profile that you sort of allow for yourself, as well as the concept you have of the trade, and take it example by example. There's really no one way to look at it for any trade. You know what I mean?
I'm sorry. Yeah, absolutely on that. Yeah, a lot of really interesting themes here. But one question on this, what you're just describing here on the 1330, 1370, is there a position before that you're seeing? Because, once again, it gets back to we could have a massive rally, one of the largest rallies we've had in years, and, you would make zero on it because if it goes up $100, basically you're not participating until, we get up over $100 from here.
Okay, so in your bull case, then let's take that example and go with see if we can get some concrete time frame. So tell me what if you're playing, person X.
Well, I think somebody bullish right now, if they can get $60 out of gold, they'll be dancing.
Okay.
We haven't seen, as Larry would say, we'd be dancing. We haven't seen, $15. Actually, I think we did have a $20 move or $18 move earlier this week. That was the biggest up move we've seen in a heck of a long time.
Absolutely. Well, I think what you're bringing up kind of mentions, let's bring up what you're talking about and just discuss that for a second, because I think it's an interesting point. You're saying, we're not seeing these moves very often. So therefore, what is there that we can do shorter and shorter term that might really pay off if it hits in $100? So we can look very simply, right? We take our target and we say $60 move would be great. $60 move gets us to 1260. And if I want to buy the 1260 call, or let's say I want to buy the 1240 call so that I can get $20 in here, what two calls do I have to sell against that to be able to be flat premium? And the answer is it's kind of like the 1265 call, right? So I'm going to end up being long for 630, one 1240 call, and then I'd have to be short two 1265 calls, and that's about flat premium, which means that if we do rip to 1300, then in this particular example, where were we here? 620, right? 1240. In this particular example, if I own the 1240, 1265 1 by 2, and again, in the market, don't look at the theoretical value. In the market, I can do this trade flat. If I own that, then, and we go to 1265 and stop, hallelujah, we're dancing, as you say, because I made $25 on a flat premium trade, right? Because I get to buy one future at 1240, I get to sell two at 1265 when we get there, but it never gets there. So it's fine. I just collect the premium. This expire worthless, and I own a 1240 call, a future at 1240, and at expiration we're trading 1265. I've made $25. That's fantastic. That's a way I can capitalize on it. But I don't think that's really necessarily an intelligent play, because if you were to break out that much in the next, say, 50 days, which is
right, then you run into problems past 1260.
Exactly, because if it goes to 1300 with this trade, you've actually lost money, because again, you make the $25 from the one that you're long to 1265, but then you're short one from 1265 to 1300, which is $35. So you've lost $10 on a trade that goes to 1300, which is that $100 we were looking for. And that's why I say you got to be very specific with like what your trade concept is, as opposed to saying like, hey, I think this is the best trade out there. I can't tell you that, right? I mean, that would indicate that I feel like I have insight into when this consolidation pattern might move, and I really don't. So what I have to do, and I think the good process for people as they trade and find trades with good technical levels and good trade concepts that they can, really think about, is to take a look and do exactly what we're doing here. Look at the 1x2s you can do for flat premium. Ask yourself, hey, maybe I don't mind spending $100 in premium here, and just, for that rip up to 1260, I can buy, the 1240 calls, call it 15 times, 16 times. And if I get up to, 1300, or, I'm making a ton of money. I'm making like $800 or something like that. I mean, that's great risk reward. Yeah. So that's the other thing I think you have to consider is, do you need to capture this trade right now and make a ton on it? Or are you happy with the idea of having a good risk adjusted trade on that is likely to profit over more scenarios than the price that you're paying for it? And I think that's why,
right.
I look back and I recognize what you said, that trade we talked about before, that 1330, 1375 1x2, look, it might not work out. We might not get there. Now, as we approach expiration, just so listeners know, let's say we're 10 days out, okay, and we're trading 1300. 10 days before expiration, where this 1x2 is not in the money, it's still going to probably be premium to the one at this point. So you will still profit off of a trade like that, even if both don't go in the money, if you slowly start to approach the lower strike that you're long as you go towards expiration, because the further out options.
Hey, Ben, I got to cut you off because actually we're running a little late, and we're actually having a pretty big move in the markets here. And so Larry wants to come on and talk about the markets. But, you've got a lot of really interesting strategies. It was very useful looking at some different ways of expressing views using 1x2s, put spreads. Very, very useful. We really appreciate it, and we'll definitely speak with you soon about that.
All right. Sounds great. Thanks for the time.
Thanks a lot for joining us.